Generation Y may be up to date on Lady Gaga's latest song or their friends' status updates on Facebook, but when it comes to investing, they're out of touch. Charles Schwab found in a recent Retirement Pulse survey that investors with the longest time horizon are the most risk-averse and, counter to conventional investing wisdom, are planning on pulling their money from the stock market. It's a refrain we're hearing more and more. Many young Americans don't trust the stock market with their money. Christina Lawrence, a 26-year-old marketing professional.
The stock market, it makes me very apprehensive in general, only because I don't know much about it, but what I do know about it makes me want to step way far behind and actually take all my money out of the bank and even put it under my mattress. That's how worried I get about the stock market.
She's not alone. According to Charles Schwab, 29% of those ages 18 to 34 reported they plan to pull money out of the market in the next 6 months, compared to only 11% of older Americans.
The problems that I've seen basically are they're a little bit more reluctant to invest possibly at the same level maybe that their parents invested historically because of some recent turmoil that we've seen in the markets. It's not so much an information gap per se, it's more of a perception issue for Generation Y.
It's no wonder the current generation has lost confidence in the stock market. If you were invested in stocks since the year 2000, your return has been marginal as measured by Standard & Poor's 500 stock index. Then there was the so-called flash crash in May 2010 when the Dow Jones Industrial Average plunged nearly 1,000 points, only to boomerang back in 20 minutes. Add to that constant volatility and more recently the botching of Facebook's initial public offering, slated to be one of the biggest technology IPOs of all time. Instead, one of the biggest confidence busters of all time. What do you say to young investors who have lost confidence in the stock market? They're staring at more than a decade of zero return. The scars of the financial crisis are lingering. They've gone through the so-called flash crash of 2010 and most recently the botching of Facebook's IPO.
One thing that is a pretty consistent fact in the market over long periods of time, the market, the S&P 500, typically returns roughly about 8%. That's how it's been as far as we can track the information back. We track numbers back to the early 1920s. Typically, you'll have a period of parabolic growth where the market runs up very quickly in a short period of time. What will happen after that is the market reverts back to the mean. So if you get 8% over long periods of time and you have a short period where the market runs up very quickly, you could have a prolonged duration where the market vacillates. That's what we're seeing now. So the markets, when they ran up into 2000, that was the strongest bull market that we've seen in modern history. So it's not surprising that we vacillated. The period from 1999 through 2008 was the worst 10-year period in modern history. But the good news is the ensuing decades, when we've had a tough period, a tough decade, the next 10 years, the next 20 years, you've typically seen outsized returns.
Harris offers the following tips for young investors. Number one, decide what you want. Define different buckets of money and decide what those assets will go towards, whether it's money you're squirreling away for your retirement, a wedding, or your first house. Number two, figure out your asset allocation plan. Divide your money between stocks, bonds, and cash. Your allocation for these three assets depends on your goals, time horizon, and risk tolerance. If you wanted to take an aggressive approach, you might earmark 80% of your money for investment in stocks. If you're more conservative, you might consider 40% or less in stocks and the rest in bonds and cash. If you have more than 7 years to save for your goal, say for retirement, you can afford to invest a larger percentage of your money in stocks. Harris warns the biggest mistake he sees young investors make is being overly conservative and not investing a large amount in stocks.
If you have a very long horizon, you can afford to be a bit more aggressive. Also, because interest rates are very low, you're not getting a great return on bonds.
And number three, once you've figured out your asset allocation, monitor your progress to make sure you're on track and adjust as needed. One way to do that is by comparing your portfolio results with industry benchmarks, such as Standard & Poor's 500 stock index.
The most important thing that you have in your favor is time. The time value of money is powerful. And that combined with compounding it makes a dramatic difference. Time value is more important than any mutual fund that you pick. It's more important than any stock that you may be researching. People always want to know the best stock to pick. It's starting right away. That would be the best advice I could give anyone.